America owes tens of trillions of dollars. Honestly, it's a number so massive it almost completely loses its meaning, right? But think about it. Who exactly is owed all that money? And maybe more importantly, what does this massive balance sheet actually mean for the everyday economy? Today, we're cutting through the noise. We are looking purely at the data to understand the underlying architecture of the U.S. national debt, and we're going to separate the economic facts from the political myths.
Almost $39 trillion. According to estimates tracked by the Peter G. Peterson Foundation, that is what the total U.S. national debt is approaching right now. It's literally the culmination of decades of financial decisions, emergency economic crises, and long-standing structural imbalances. But a number alone doesn't tell the whole story, does it? It's really just the starting line for our investigation today.
Now, you've probably seen the alarming headlines warning of some impending economic doomsday. So we really have to ask, could this mountain of debt actually trigger a sudden financial crisis? Or is the reality of macroeconomic policy a whole lot more complicated? If you picture the imposing columns of the U.S. Treasury building alongside everyday families sitting at their kitchen tables budgeting for the month, you start to see the two very different worlds this debt bridges.
All right, let's dive into our roadmap. First, what exactly is the debt? Second, why it grows. Third, why investors keep buying it. Fourth, the risks of rising debt. Fifth, the real-world impacts on you. And finally, can we actually reduce it?
Chapter 1. What is the national debt? Let's get our foundational definitions straight.
I know the terminology can be a little confusing, but it operates a lot like personal finance, just on a much, much grander scale. The annual budget deficit, that's basically your yearly budget shortfall. It's what happens when the government spends more in a single year than it earns in revenue, putting the rest on a national credit card. The national debt, on the other hand, is the total accumulated balance on that credit card over the nation's entire history. Every single year there's a deficit, that national debt grows.
Now, when we look at who actually owns this debt, a reality emerges that usually surprises people. A massive portion is held right here at home. We're talking U.S. pension funds, mutual funds, domestic investors, and even the Federal Reserve itself. This fundamentally dismantles the common myth that foreign nations own all of our debt. I mean, sure, foreign governments do hold a significant share, absolutely. But a huge percentage of what America owes, it essentially owes to its own citizens and institutions.
Chapter 2. Why does debt keep growing? Let's look at this upward trajectory.
So the real driver is sitting right here in the Congressional Budget Office data. Just look at the projections for fiscal year 2026. The government anticipates spending roughly $7.4 trillion, but it's only expecting to take in $5.6 trillion in revenue. That creates a massive $1.9 trillion gap for just one single fiscal year, pushing the debt held by the public to over $32 trillion. It is a persistent, structural mismatch between what the government commits to spending and what it actually collects in taxes.
And beyond mandatory spending on programs like Medicare and Social Security, and discretionary spending on defense, there is a rapidly growing new driver: interest. Get this. A really sobering fact from the Peterson Foundation points out that interest costs on the existing national debt are expected to rapidly outstrip federal spending on children in the coming years. When a debt load becomes this massive, just paying the interest turns into a dominant budget item, creating a compounding cycle that drives the total debt even higher.
Chapter 3. Why investors buy U.S. debt. The mechanics of global demand.
You might be wondering, despite these staggering numbers, why do domestic and global investors continue to pour their money into Treasury securities? Well, it's because U.S. debt serves as a global benchmark security. During times of global uncertainty, investors seek safe haven assets, and U.S. Treasuries are historically viewed as the absolute safest bet in the world. This is deeply tied to the unmatched strength of the U.S. dollar in global trade, strong historical credit ratings, and a highly reliable, transparent Treasury auction process. The global financial system essentially relies on U.S. debt to anchor it.
Chapter 4. Risks of a rising debt. Let's look at what could actually happen.
Okay, let's lay out the stark warnings from institutions like the Congressional Budget Office and the International Monetary Fund. The CBO projects our federal debt could reach 120% of America's gross domestic product by 2036. That is huge. The IMF warns that rebuilding fiscal buffers is absolutely essential. The big risks here include higher interest costs eventually crowding out private investment, which means less money available for businesses to grow. Plus, high debt severely reduces the government's fiscal flexibility to respond to future emergencies, like pandemics or severe economic downturns, and threatens to deplete crucial public trust funds. But to be perfectly impartial, we have to look at the counter-arguments. Many economic researchers argue that the absolute size of the debt isn't everything. Sustainability actually depends heavily on economic growth. As long as the U.S. economy grows faster than its borrowing costs, the debt can remain manageable. Relative inflation rates also play a role in effectively shrinking the real value of that debt over time. And as long as global investor confidence remains high, the U.S. retains an unmatched borrowing capacity that really defies traditional household budget comparisons.
Chapter 5. Real-world impacts on you. Let's bring this down to the micro level.
I want you to ask yourself, how does this massive macroeconomic policy actually affect your kitchen table budget? Because when families sit down to pay bills, plan for retirement, or apply for a mortgage, they are unknowingly interacting with the consequences of the national debt. Let's connect these high-level Treasury policies directly to your daily life and the actual cost of living.
Let's walk through this step by step. First, persistent high government borrowing can put upward pressure on inflation and interest rates, which directly translates to higher mortgage rates and student loan costs for you. Second, according to the Peterson Foundation's analysis, the primary Social Security Trust Fund is projected to be depleted by 2032. And without reform, that triggers an automatic 22% cut in benefits. Third, the Medicare Hospital Insurance Trust Fund could be exhausted in just 7 years. So you see, unchecked debt isn't just some abstract number. It directly influences your taxes, your retirement security, and the government services you rely on.
Chapter 6. Can we reduce the debt? Let's talk about fixing the problem.
Now, there are absolutely no easy fixes here. Every path involves difficult trade-offs. Relying on strict modeling from the CBO, policymakers generally look at 4 main levers. Spending reductions can lower the deficit, sure, but they might reduce public services or economic stimulus. Tax reforms can increase revenue, but critics argue they could slow private sector growth. Faster economic growth is the ideal solution, expanding the tax base naturally, but it's incredibly hard to guarantee. Finally, changes to entitlement programs like Social Security and Medicare are mathematically impactful but highly sensitive for the millions who rely on them. Every single choice requires a delicate balancing act.
So, looking at the sheer size of the debt, the structural deficits, and those looming trust fund deadlines, we arrive at the million-dollar, or I guess trillion-dollar question. Should Americans be worried?
Well, the consensus among nonpartisan analysts is generally one of urgent caution rather than outright panic. As this quote from the Peterson Foundation perfectly captures, America's fiscal challenges are serious, but they can be solved. We can choose a better path. The national debt is undoubtedly a critical long-term challenge, but its ultimate impact depends entirely on future policy decisions, the underlying health of the U.S. economy, and our collective ability to have honest, evidence-based conversations about revenue and spending.
The main takeaway today is to focus on the evidence, not the alarmism. The numbers are definitely daunting, but the U.S. economy is also incredibly resilient. Understanding the mechanics of the debt empowers you to look past the political rhetoric and grasp the real economic stakes at play. The ultimate impact depends on the choices we make today. Will policymakers chart a path towards sustainable growth, or are we simply leaving a mathematical time bomb for the next generation? Think about that for a second. If you found this explainer helpful, make sure to subscribe for more evidence-based deep dives. Thanks for watching, and we'll see you in the next one.